do it live. And the Hangout on Air is live. Welcome to our broadcast live from beautiful, sunny, sort of California, the home of Mr. Eric David Greenspan. And welcome and thank you for joining us this morning. We have Patrice with us, who hasn't been with us in a very long time on a Hangout. Good morning, Patrice. And we have Chris, who I think it may be her first time here.
Welcome.
Hello.
And for those of you who came in after person number 3, make sure you unmute so that we can hear you, if you want to be heard. If you don't want to be heard, then do nothing.
Just gonna stalk.
And by the way, if you look in my background, you can see that there's an alien in my window behind me.
Looks like a flat, looks like some sort of light or something.
Yeah, it's a spaceship.
Patrice says she doesn't have a
one.
video.
That's not going to work.
What's that?
I'm about to be abducted. And I've got my Intuit coffee mug today. I'm representing.
There you're representing.
And then I've got my special mug.
Hey. Who sent you that?
Eric made it and sent it to me and brought it as a gift.
Awesome.
And we've even gone floral. I want to do a broadcast from here every week from now on.
No.
Well, you gotta have Derek turn off his sound. You're echoing again.
I'll lower mine because his is probably better.
I'm going to go mute because I'm going to let Seth talk. He likes it.
Okay, I could hear from yours. Yours sounds better.
I'm fine. I'm just paying attention.
So, light crowd. Let's check the room, the event room, and see if we have people trying to get in. Yeah, the table's moving. I don't know if we can prop something. Yeah.
I thought you were on a boat.
We're gonna stick my Android phone under one of the table legs here so it doesn't wobble.
That's
Good
good.
use of an expensive phone.
That's good.
So in another minute or two, we're gonna go. We're already live, but we're gonna start the presentation. Just to catch everybody up, remember 2 weeks ago we started doing the cash flow projections based on a sample QuickBooks file. But timing sort of worked out well in that I just completed a model for a client, and so I took hers actually and I gutted it out with respect to anything sort of that would name the client specifically. So this way I have a real live example of a financial model to show you. To show you cash flow projections. So, where's the song? This is how we do it.
He's muted.
Yeah, but my mic's here. My mic's live. Boink, 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 boink. So, it should be an interesting sort of case study on this because it brings up 2 issues. One is the cash flow projections, which was what we were talking about really specifically 2 weeks ago, but it also brings up the subject of the whole business valuation thing, which we had done. There we go. Can you hear it?
Earworm.
There it is. So now if the verbal version of it didn't give people the earworm, that one for sure will.
DJ EDG in the house.
DJ EDD. EDG. Edg. Edge. The edge. So anyway, because there's a business valuation component built into this, and the specific use case here is that my client is looking to open up a new business, and they're looking for financing. So the whole point of this, besides being able to look at different scenarios and seeing what it looks like if we change this assumption or that assumption in terms of the impact on cash flow. We also want to decide, because the reality is if the business doesn't exist yet, if it hasn't opened its doors and it doesn't have any real sales to speak of, then everything is theory, right? So if I'm going to a potential investor and saying, this is what I think my business is worth, you have to kind of say, well, what's that based on? If you have sales, then you can base it on actual data. But if it's all theory because you haven't even opened the doors yet, and you know, in this case, for example, need the financing to get the doors open, then it's all theory, which means that the only basis on which I believe you should be valuing a company like this is on the basis of how am I going to provide a return on investment that is going to attract the investor, right? Because I can sit there and get all hyped up and use the hype and say my business is worth $2 million. But when I run the numbers, like I'm going to show you guys that I did for this client, we got an echo. So that's not us because Eric is muted.
No, I'm not.
Oh.
Yes, I am.
Is your mic muted?
Everything's muted. It's not me.
So it's not Eric. It's somebody else. So are we still echoing? Do we still have it?
How about now?
Because I don't hear an echo at all.
All of a sudden, you did a delay thing. It may be the internet. Sorry.
Okay. Yeah, Eric, I don't think it was you. So what I was saying is the basis on which we're going to value the business can't really be on anything other than what's going to provide the right return. So if we've run the numbers conservatively and we're showing somebody what we very realistically can expect to do in the first 1 to 5 years, then we can value the business based on what's going to be attractive to the investor, right? If I value my business at $2 million and then I look at the timeline and see when are they going to actually see a return on their investment on that basis, and so when is it going to go, and for that matter, when are they going to recover everything they've invested? Because that's what a lot of investors want to know. How long is it going to take me to make my money back? Because then after that, after they get that, the return of their original investment, then they're in the black, so to speak, right? They're in the red from the moment they make the investment until they recover that investment. And then what I like to do is I like to look at when is the ROI going to hit 100%. In other words, are they going to make back their investment plus invest it again, right? That to me is critically important to be able to show an investor, and you have to do it in a way that you can support the numbers you're giving to them, and that's realistic and conservative, right? The idea is that once you get the ball rolling and you do open the doors, you want to, as much as possible, make sure that you're going to, if anything, do better than what you projected. So, and that's, of course, why we say it's important to be super conservative in your numbers, which means, of course, aim low on the income and aim high on the expenses, if anything. Now, this particular case that I'm going to show you guys is, I liked it, especially when the project came in my door, because it was very similar to a rental property type situation. It's somebody who has hair salons, and she's already got an existing business up and running, and it's a new concept where she's going to build out a very large space and rent out studios to stylists so that they can have their clients come in, and it's open 24/7. They can come in anytime, day or night, 7 days a week, and bring in their clients and do people's hair. And so it's very similar in that we're renting out studios to people instead of renting out apartments. And there's a build-out involved, right? So there's an assumption you're going to see about what we expect it's going to cost to complete the build-out. And so now we're renting the place ourselves, so it's going to be an improvement, capitalized improvements on the balance sheet. And then we're going to look at, and I love this for this example because we're going to look at a situation where we're going to have things like prepaid insurance for liability insurance and how to build the amortization of that into the projection so that when I make the prepayment, it impacts cash flow the way it should, which is a big cash outflow that's not included in net income because I'm prepaying, right? So it's on the balance sheet. And then we're going to amortize that and have that flow out from the balance sheet to the P&L in 1/12 chunks, right? And so you're going to see what that looks like in a few minutes when I show it to you. And we've got some assumptions in place insofar as how quickly we expect we're going to fill the units from the time that the build-out is completed until the time that we've got full capacity. We have an assumption of a 10% vacancy rate. And there's two ways you can approach something like that, where I can say, all right, I'm going to actually model the units and how many of them are going to go empty and build that 10% assumption in. But I kept it simple in this case, and I said, you know what, I'm just going to deduct 10% off the top for every month of revenue to account for that 10% vacancy rate assumption. It's much easier to do it that way, frankly. So I'm going to show you what this all looks like, and I wanted to preface the whole thing by sort of explaining it first so you kind of know what you're looking at. And so anybody have any questions or comments before I start sharing my screen?
I have a question. So basically, it's kind of like real estate where you get a cap rate and divide that by your cash flow to get the return on investment. If it's good enough for the investor, he'll go with it. If it's not, then he won't.
Well, it's a little simpler than that. We're not so much looking at cap rates. They make the investment, and the way you're going to see I have it laid out, the investment is broken up into 2 lump sums, and then I just look at the cumulative projected earnings compared with that investment to see what they, when they will see a return on their investment, and when that will go. Like I said, I consider it negative ROI until they reach a point where they had all their capital returned to them, right, where the business has made enough money that it's covered what they've invested, and then the ultimate objective is to see when will that ROI become 100%, right? So if they invest, as you're going to see, $600,000, when do they get back $1.2 million is really, to me, the critical point that I want to be able to show in the timeline and say, well, there's 2 critical points. One, here's when you're going to get back your original $600,000 investment, and here's when you're going to get back $1.2 million, which means you've now made back what you invested plus, the same amount again. So, I try to keep these things real simple, because when you start talking about cap rates and things, you lose a lot of people. So that's kind of the way the reason why I approach this the way that I do. And what also happens is a lot of people, they don't want to sound, sort of dumb, so they don't ask, well, what is a cap rate, right? And so they just, and then you think they understand everything you're explaining to them, and all of a sudden they're lost. And so to me, especially when I'm presenting this to a potential investor who may or may not be savvy enough to understand these things. It could be somebody who just has the money, but you never know who you're dealing with. So I want to make sure it would appeal to anyone, and that's why I try and keep this as sort of unsophisticated as I can possibly keep it, without sacrificing presenting actual meaningful information.
Something you could take to the Shark Tank?
I'm sorry?
Something you could take to the Shark Tank?
Don't they need to what to the Shark Tank?
I said, isn't this something you could present to the Shark Tank?
Yes. So this is, remember, I did the series on business valuation at, on the School of Bookkeeping site. We did it as a free course. So, and that partly inspired this, because yes, the whole idea is to be able to put the number. They tell you have to know your numbers before the show. And if you notice when you watch the show, there's going to be 2 things you have to do. You have to sell them on the idea, and as soon as you've sold them on the idea, then you got to sell them on the numbers, which means you got to know your numbers. You got to know what you can expect. And the reality is, if you've watched the show, any business who comes in there without having any sales and proof of concept, they're going to blow them out of the water. I don't think I've ever seen them invest in a deal that didn't have some kind of a proven track record. Right, so you have that much more of a challenge in a situation like the one I'm going to show you, where there's no existing sales, no existing business. If anything, we would have to capitalize on the fact that she has other businesses in the same field, and has that experience that she can show, hey, I've already proven I can do this. I'm just expanding and growing, sort of thing.
So this would be a major component of the business plan too, right? If you took it to a bank, or because usually they want, yeah.
Yeah, in fact, this is exactly the kind of thing banks want to see, and very similarly, when the bank loans you money or makes a decision about whether or not they want to, it's the same kind of decision that an investor makes. They're investing in your company. They're counting on your company performing well enough that you're going to be able to pay back that loan with interest, right? So, and in fact, when we look at a deal like this, sometimes part of the process and part of the purpose behind putting together numbers in this way is to look at, do we want to do equity financing? Do we want to do debt financing? Or maybe a hybrid? And that was one thing I had discussed with this client when we were looking at this, is that maybe we don't need the whole $600,000 as an investment. Maybe we only need $300,000, and then we'll ask as part of the deal. And you've seen this kind of thing happen on Shark Tank a few times, more than a few, where they'll say, look, we'll invest, we'll give you this much money, and then we'll also make a line of credit available to you. so that you have it if you need it. But it's not, but that's going to be a debt financing solution, where if you need it, you borrow it and then you pay it back with interest. So that's the difference, of course, between debt and equity financing. And a lot of times, by getting creative and doing some kind of a hybrid of the two, you can, you can hold on to more of your company and not have to give away as high a percentage in exchange for what's being invested by, doing some form of debt financing in tandem with the equity financing. So the downside is with debt financing, you got to pay it back. The upside is you don't have to give away as much of your company. So I'm going to share my screen with you. Let me know when you can see it, because it minimizes my window when I do this now.
Yes.
We can see it.
Okay, so what you're looking at here is the assumptions table. And by the way, the other thing I didn't mention is that what we ended up deciding to build in here is a provision where we would provide an incentive program, almost like an affiliate. And I was joking with her saying we could do it like multi-level marketing, where we have the existing tenants bring in other tenants, and we compensate them for doing so. So, and she actually, I said it jokingly, but she actually liked the idea. So we built in an assumption where we said we're going to compensate them based on a percentage of the revenues for anyone that they bring in, and on that basis we accelerated the monthly tenant acquisition. So originally it was half of what you see here, and this means we have two different size studios that are going to be built. One size is 150 square feet, and we're going to have 13 of those, and the other one is 100 square feet, and we're going to have 37 of those. So we're going to have a total of 50 studios. Okay, and then we have the weekly rent, and of course from that is derived the monthly rent. And what's interesting that I'm noticing here is that it's, I think I might have the, oh, you know what, I did protect the formulas. Bear with me here. I'm just going to unprotect the sheet now. This is interesting. I wonder if this is a Google thing where it's not showing my formulas in the formula bar. Okay, that's new. Let me try closing and reopening this for a minute.
Could be our lovely Microsoft.
Yeah.
Export it to Excel.
It is Excel.
Export it to Excel.
Penny's checking out something in the background there.
Is probably
Okay,
a
so
barrel.
now it seems to be working, so we'll see if maybe for some reason it's based on me sharing my screen. All right, let me know when you can see this.
We can see it.
Well, it looks like part of your screen is showing through.
Oh, okay. I thought it was just me. There's like a
Oh, I thought he
cut
blacked
out.
that out.
What's that?
Part of your, it's kind of split in the spreadsheet, and you got your screen showing through part of the spreadsheet.
Yeah, I can see
Let
the
me
top
do,
of the window.
I just did the present to everyone thing. Maybe that'll fix it.
No, now it doubled. There's like on top of the spreadsheet is just a sliver of your camera showing the curtain rod. Weird.
That's weird. Okay, I'm not sure what to do
Can you
about that.
minimize and make it just minimize Excel and then make it bigger and see if it'll clear it?
Okay.
That's better.
There you go.
There you go.
All right.
Ooh, one for Sarah.
So I don't know what was going on there, but now we can see my formula. So anyway, the monthly rent, of course, is derived from the weekly, just multiplying by 4. And then what you've got out here is a table that looks at how many people we have, occupying the studios. So I've got the build-out takes 4 months. That's one of the assumptions that we have in place here, is that the build-out will take 4 months. Somebody's echoing now, so if you guys can mute. and just unmute if you want to ask a question or something. So there's an assumption that the build-out will take 4 months, and then obviously after that we can start occupying the place. Now this is a challenge because what happens is one of the other assumptions is that we still have to start paying rent in month 1, and the rent's high because it's a very large facility. So the rent, as you can see down here, is actually $32,000 a month. The annual rent is $385,000, which means that we have a big expense in the first 4 months that there's no revenue to derive as an offset to that. So we're going to run at a big loss the first few months while the build-out's going on. Plus there's the cost of the build-out, which, as I stated earlier, is a cash outflow that has to be taken into consideration, which is not included in net income because that's not going to hit until we start actually depreciating, which is not going to happen for a year. So out here we look at what happens. Now, like I said, based on the fact that we created this incentive program, what we're doing is we're accelerating the rate of tenant acquisition. And there's a built-in assumption here that, because originally, like I said, this was half of what it is now. It was, and the natural assumption is the bigger, more expensive place is going to fill up more slowly, right? So we're gonna assume we can fill up 4 a month on the less expensive one, and 4 a month on the more expensive one, rather, 8 a month on the less expensive, right? Because the less expensive obviously will attract more people. So based on this and the fact that we're accelerating it because of the incentive program, we came up with 4 and 8. And this was a conversation I had with the client. I said, can you do this? Can you, when it was 2 and 4, I said, can you fill this up? Can you fill it up at the rate of a total of 6 per month? And she said, yeah, no problem. And then we figure if we're providing that incentive, then the tenants, as they come in, will then provide still more tenants. So that's the basis of the acceleration. And that makes a big difference in terms of how much revenue comes in and how quickly, which has a big impact on cash flow, which is why you have to do this and really look at the whole picture. Because I can't just look at what's net income, I have to look at cash flow. So let's start taking a look. The last piece of the puzzle that I created when I built all this were the annual statements here. And you're going to see for now it's a very simple balance sheet. There's not a whole lot going on here. We have a checking account. We have prepaid insurance because, as you're going to see, that gets significant for a business like this. We have the property improvements, and we're opening up ultimately 3 facilities. So we're opening up 1 facility in year 1, a 2nd facility in year 3, and a 3rd facility in year 4. So that's why this keeps increasing. So we're going to increase the the asset here each month. I haven't built the depreciation into this yet, which is why you don't see the accumulated depreciation coming out. That's one little piece that still has to get done. And then what we did was because we know who's doing the construction and it's an arm's length relationship with that person, we know that that person's going to let us accrue a payable to them. So in other words, they don't need to get paid right away, which is a nice benefit to this, which means that we can sort of pay it back when the money is available out of profits. Not an arrangement you're going to get if you're just contracting with somebody on the outside. So like I said, this is because there happens to be an arm's length relationship with the person who's going to be doing the build out. And then we're looking here at what the investment is going to be. So in year 1 we get an investment of $300,000, in year 2 we get another $300,000. And then of course we've got our retained earnings, which is flowing over from the P&L. Now let's go back to the assumptions here so you can kind of see. Here's where I have my notes. So the total cost of the build-out per facility is $300,000. Here's the rent assumption, and over here is where I do my quick little business valuation. Right, so I drop in how much I want, how much of the company I want to give away in exchange for that. So right now we're looking at giving away 30%. So again, if I'm asking for $600,000 in exchange for 30%, then I've got a $2 million valuation based on that. So this is where these numbers count, because then I got to look, and I'm going to show you in a few minutes what this looks like. I got to look at, like I said earlier, is this realistic? Is an investor going to want to invest in a company to get 30%, and on that basis be able to, recover their investment at a quick enough rate that they're going to get excited about this? So that's the ultimate question we're trying to answer here, is will they get excited based on this valuation with what their ROI looks like? Obviously, the lower the valuation, the better the ROI. So, but that means I've got to either give away more of the company or reduce the amount that I receive from them. So it's a balancing act, and having a model like this in place allows you the opportunity to play with different scenarios and see what's going to work, so that by the time you walk into the Shark Tank, you're ready to do business. You know, you're ready to negotiate, and you have a solid foundation in the numbers in terms of what you're presenting to them. So over here we've got the annual P&L. Of course, this again is just an accumulation from what I'm going to show you in a minute. So this part is not really all that exciting. And you notice what I've done is... Sorry, does somebody have a question?
Yeah, we're not seeing the screen move.
No, we're seeing the same picture from the beginning. We thought you were just talking.
All right.
I thought it was just me.
All right, so let's stop screen sharing, and let me just do my whole screen instead of the spreadsheet, because maybe it got fixated on that workbook.
Yeah.
So let's do the entire screen here. Now you're going to get the wormhole.
Right.
All right, so now tell me if you see the annual P&L.
Yeah, look at that. No, we hadn't seen anything that you were showing us.
All right, so let me just do a quick recap. So I was looking at the assumptions. Here's the valuation part. Had you guys seen that?
No, we didn't see any of it.
Okay, so here's my little quick pro quo on the valuation, and this is what I was showing while I was demonstrating. Is, you know, we're looking at getting an investment of $600,000 in exchange for 30% of the company, which translates to a $2 million valuation. But if I decide, when we look at what the ROI looks like on that basis, if I decide that it's not going to be exciting enough to the investor, then what I'll have to do is either reduce the amount I take in or increase what I'm giving away. So I could say I'm going to give away 45% of my company, take in the same amount, and now I've lowered the valuation, which is going to result in an increased ROI to the investor. Or I can say, give me only $300,000, which reduces the valuation by half, of course, but the problem with that might be what impact that has on cash flow. Am I going to have enough money to cover all the working capital, especially when, as I said, I have a large upfront cash outflow that I need to be able to cover in terms of the build-out, where there's no revenues coming in to offset that, at least for the first location. But by the time I get to location 2, I have the ongoing operating capital and profits from location 1, which might hopefully help to fund that, so that I won't need to take in any more investment money or borrow for that matter. So I was showing the annual balance sheet, which just goes, you know, it's a 5-year model. So, and as I was saying, it's very simple. I've got my cash, I've got my prepaid, I've got the improvements, which I haven't built the depreciation schedule into yet, and I've got my construction loan payable or construction costs payable, because as I was saying, this is a case where we have an arm's length relationship with the contractor, so that we're able to work that out. The contractor is willing to get paid out of profits when available. Wow. And it helps to know people, right?
I was about to say, how'd you do that?
Yeah, no, it's, I mean, I didn't do it. This is the client. So, you know, the client is leveraging relationships that she has. So, you know, that, and that often helps, and that often is what makes the difference between being able to get a business off the ground and not. You know, is getting people who really believe in what you're doing so that they can jump on board with you and get behind you. You know, and a lot of times what that means is they'll be willing, if they really do believe in you, to provide whatever it is that they're going to provide. In this case, the construction, the build-out, and not worry about getting paid right away, because they know that in the long run it's going to pay off that much more. So these are all things that get considered when you're putting something, a deal like this together. And you might be able to see at the very bottom of your screen that I've got the very beginning of the ROI analysis, but I don't want to show you that just yet. So now let's go over to, so the profit and loss annual is, as you can see, what I've got here is I've got what look like hyperlinks, and they are. And you'll see what I've done is, and the way I've started to build this out, and this is something newer that I started to do really just over the past year when I do these models for people, is I will create a schedule for every single line item on both the balance sheet and P&L, so that each of those line items can be looked at and projected very specifically. And a lot of times it's not done that way. The way it's often done is you would build an assumption in and just say, well, we're going to spend this much on janitorial and maintenance, and on my monthly P&L I'm just going to put, you know, that amount, you know, and what do you call it, roll that out the same amount each month and set it equal. Instead, what I've done, which I'll show you, is I've created a schedule for it where I can do that, but I can put all kinds of other assumptions based on timelines and other things as well, which sometimes applies and sometimes doesn't. So, and then we have the annual statement of cash flows, and this, of course, is the real key. But the annual, and these annual schedules, by the way, are really the only reason I even have them here are for presentation purposes to the investors. The real functional part of this model comes from what we do on the monthly statements. So here we have the balance sheet monthly, and so again, you can see everything sort of specced out on a monthly basis. And then we have the profit and loss monthly. And so here is where you have the rent being picked up and the laundry income, because there's laundry machines, people, and they're going to be coin-op machines, which are rented. So all these things are things that have to be thought out in terms of what that's going to look like when you translate what it looks like from an operational standpoint to what it looks like from the numbers side of things, right? So the client said to me, well, we're going to have laundry machines. And I said, great, are you buying them or are you renting them? She says, I'm renting them. Great, so I don't have a fixed asset, I just have a rental expense for the laundry machines, but then we have to look at an assumption of how many loads are each person who's in a studio going to do each month, and what's that going to cost for the wash and for the dry, right? And I'll go back to the assumptions and show you what we've built on that. Then here's the affiliate commission line item, which is based on what I was talking about earlier with respect to that incentive program. And so here I'll start looking at you know, what these schedules look like. But notice, for everything that's hyperlinked, it means there's a specific schedule for that. So if I click on, let's start with rent. And that's what I love about the hyperlinking, is it just makes it easy to take over. And then notice I created a hyperlink here that takes me back to the P&L when I want to get there. So notice I've got it laid out. And this, having a schedule like this, rather than just trying to write fancy formulas, gives me the ability to be very specific, and it makes it easier, quite frankly, to build this. Because I have a separate section for locations 1, 2, and 3. I've grayed out the portion of the timeline before which the location exists. And then notice what it does. And if you look at my screen, you'll see this is all done by formula, right? Where it looks at, okay, I'm opening this location, and every time I open a location, the first 4 months for revenue purposes are 0. I don't start taking in any revenue until month number 5 in each location. And then over here I've got, and these are lookups. They're actually H lookups, which are horizontal lookups, as opposed to V lookups, which are vertical lookups. And so for the rent, it does a combination of 2 H lookups, because it has to look up the rent for each size facility. And it has to look up how many people do we have, how many studios do we have filled in that particular month, and how many of each size that is, the 100 square foot and the 150 square foot. It has to look up each of those, do the math, the number of tenants that are in those places times the appropriate amount of rent, and then combine those to get the total rent. So that's what the formula that I wrote does here, and I'll take you back to the assumptions table to show you, where it's going to get that information. So if we go back to assumptions, and what I did here, by the way, was at the very bottom left, you see the arrows down here? If I right-click on those, it brings up a list of all the tabs that are in the spreadsheet.
Oh, I never knew that was there.
Yeah, very, very cool way to navigate.
That's a cool thing.
Notice what I also did with the way that I named the sheets, because as you can see in this view in particular, it makes it really easy to navigate and see what's where. So any balance sheet account starts with BS, any profit and loss account starts with PL. So I was careful with the naming. I actually learned that from a client. I was teaching the client how to do the financial modeling according to my sort of method, and the client had come up with that. And when I saw it, I was like, you know what, that's great. It makes it so easy to find things. So
I have to say, you and naming conventions, BS done by the SOB.
That's right.
That's right.
That's how we roll here at SOB. But hopefully you don't think SOB is full of BS.
No. Of course not.
So going over to the assumptions tab, we're really going back up here, and we're looking at, in any given month, how many do we have in each size unit times what the monthly rent is. So that lookup is saying, look up the month number then tell me how many people are in this size unit in that month, multiply that by the rent, then the other H lookup in the formula says do the same thing on the other size unit, and then add them together. And then down here, and this comes up later, I have a line which just shows very simply how many locations do we have open. Because this way I didn't have to reproduce this schedule for each location. I just use this line to do the math and to do the appropriate multiplication. So I take the revenues that we're building out times the number of locations that are open for certain things. This helps with that assumption. So as we get out to year 5, month 60, you can see that we're up to 3 locations being open. So these are all little things that play into how we develop these projections. So let's go back to the rent, which is the revenues tab. So that's how, and then the laundry, it works the exact same way. And in the case of the laundry, it's not so much this different size units, but we have what's it going to cost per wash and what's it going to cost per dry, and how many loads are we doing. So we'll go back and look at that on the assumptions. And I've played around with this number quite a bit, but ultimately what we came up with was about 4 loads a week that each person is going to need to do, and $1.25 for a wash and $1.75 for a dry. So, I mean, when you think about it, it's kind of amazing the level of detail that you can and do and should put into these kinds of things. Now we'll go back to the revenues table. So, and then the revenues, like I said, we kind of gray out any portion in the timeline where it's not open yet, and then we start the formulas. And if you look carefully, what you'll see is, since I'm opening this second location up in month 25, it's not looking up month 25. It's actually referencing cell B2 here, because it's going back to what happens in month 1 of this facility. So again, a lot of careful thought goes into the development of these formulas. You'll also notice, if you can see the formula, and unfortunately even if I zoom in, it doesn't enlarge that portion of the Excel screen, but I've got named ranges. I've got timeline, I've got monthly rent, and I've got vacancy rate. So these are mechanisms that we use to help make writing the formulas much easier. Right, because it's much easier to point to a named range than it is to remember a cell reference. So that's where that helps. Plus, it also helps when I know I'm going to want to pinpoint that specific location and never have it change. So, and you've seen me present, those of you who've seen me present Excel in the past, I often talk about relative referencing versus absolute, where you have to put the dollar signs in to keep the reference absolute, so that when I copy a formula to the right or down, it doesn't change that reference. And so using a named range solves that problem too. I no longer have to worry about making it absolute, because it's a named range, which means by definition it is absolute. It's never going to change when I copy it.
Where is the named range?
So in the formula, it's here, right? So I've got a named range called timeline.
Timeline, okay.
If I hit F5, then that brings up a go-to screen where I can quickly go to any of my named ranges. Okay. And so this you can kind of see the list of all the ranges that I've named, for use in writing formulas. I've got the affiliate 50% of tenants, and then affiliate percent of gross revenues. Then I'll go back and explain what that's doing. Okay. Here's the dry cost per load, the dry loads per studio per month, right? Then I have laundry cost per machine per month. When you name these ranges, you can't have spaces or any special characters. That's why I've got underscores there. I have an assumption about the health insurance monthly cost per employee, the monthly rent for the 100 square foot, the monthly rent for the 150 square foot. All these sort of key parameters that are going to be used in calculating different things are named this way. I've got my Social Security Medicare rate, which is defined as 7.65%. And then the timeline, I'll go to that one. That takes me right over to this table on the assumptions, but if you notice, it's got this whole range highlighted, because I've defined that this whole range is going to be called timeline, and this makes my H lookup formulas easy, because I know I can look up any of these month numbers in this range and then pull a result from the appropriate row number.
Hey Seth, I have a question. When you go to building a model and you come up with all these different ranges and names, is there a process you use? I mean, do you kind of build from the ground up, or do you kind of take an over, you know, where do I want to go and what do I need to have to figure this information? I'm just kind of curious about your process.
Yeah, it's more of a build-as-you-go process, especially because every model is different, because every business is different. So, in other words, going in, and I think this answers your question, tell me if it doesn't, but going into this, when I started with a blank spreadsheet, you know, I had no idea what my named ranges were going to be and what purpose they were going to serve. But as I started thinking in terms of, okay, what do I have to do here? What have I got to lay out? You know, then I go back and start building the assumptions table, and a lot of this changes. There have been several iterations of this where, you know, I didn't have this last line here with the number of locations built into this until last night, because I realized as I was trying to write the formulas to complete the model that it would be handy to have a spot where I can go look up in a particular month how many locations do we have open. Because then I can take that result and multiply it by certain things that are going to be the same for each facility and the same each month. Then it enables me to do a quick multiplication and say, take the number of facilities that we have open this month times the amount we're going to spend per facility per month on a PR firm, and drop that number into my public relations expense line item on the P&L.
Okay, but do you have like kind of a boilerplate? I mean, with other models, I mean, I'm sure there's a lot of commonality with, you know, the different companies, you know, in terms of certain basic, you know, information needed. So you just basically take a template and build and customize the template, or do you build from complete scratch?
I always build from scratch. I've tried doing what you're describing, and again, what happens is because each situation is so different, it winds up being more work to try and figure out how to adapt a template to a situation than it is to just build it from the ground up.
Mm-hmm.
Plus, it's kind of fun to me to build it from the ground up. I mean, to me, I love doing this stuff. So, you know, using a template might actually even take some of the fun out of it.
Interesting.
So, what I do, however, is I create a template for a profit and loss account and for a balance sheet account. So, a profit and loss account is very simple, right? I've got the month number. And in here I can put in whatever the amount's going to be for each given month, and of course it gives me the total, right? And then once I've got this created for a particular expense line, then I just flow it over to the P&L. Very simple formula, go to the P&L, hit the equal sign, come over here and point to the total for that line. So for any P&L account, this becomes very easy. For a balance sheet account, there's an added dynamic in the fact that I have to have a beginning and ending balance, because a balance sheet is a cumulative or permanent account, right? So I start with month one, and I say whatever this balance sheet item is, I'm going to get $100 of it in month one, and of course, look what happens. Now it drops down to the ending balance, which then flows over to the beginning balance in the following month. And I want to show you a good example of where this really becomes important in a situation like this. Let's go look at my prepaid insurance. So liability insurance is assumed to be $6,232 per year per facility. So this is one of those cases where it's looking up on the timeline to see how many facilities have we got open, multiply that by the 6232, and give me that result. Then down here in month one, we're going to take whatever's there and divide it by 12, right, to come up with the monthly amortization. So here's my net cash outflow for this prepaid is the $57,1267. Right, and really, it's really the whole 6232. But what we're doing here is we're carving 1/12 of it out of here and putting it over onto the P&L. And then we're going to look at the statement of cash flows in a minute, because on the statement of cash flows is where we've taken effectively everything that's on the P&L and started there with our cash outflow assumption. And then, of course, we reconcile that to the cash balance based on what's going on the balance sheet. So this is where, if you've taken the course that I put out there on understanding your financial statements, that's in School of Bookkeeping now, it makes a tremendous difference in terms of when you understand that stuff. I had to understand that stuff really well before I could do this kind of stuff. And the reality is, the way I ultimately learned it, because the thing that really escaped me, and Dennis, I think you'll appreciate this, when I was in college and I was taking the CPA exam and preparing for it, the statement of cash flows completely escaped me. And there was a section on the CPA exam where we had to prepare one, and I didn't even bother. I just skipped over the whole thing because I couldn't for the life of me get it. And it wasn't until I was in the real world working, I was already, you know, my own company, but I was working closely with a CPA firm who sent me out to work with clients. And in one particular case, we had to build a financial forecast for a company who was looking for financing. And I had to build this, and I had to include the statement of cash flows. And I said, uh-oh. And so, but by getting thrown into the lion's den, so to speak, it forced me to do it. And you know how I ultimately learned how the statement of cash flows worked? You're going to laugh at this. I opened up a sample QuickBooks file, and I ran the statement of cash flows on it, together with the balance sheet and P&L, and I studied every single line item until I understood how QuickBooks was arriving at the amount for that line item on the statement of cash flows. And eventually I figured it out. Okay, it's changes in balance sheet account balances. Using that change to reconcile with between the net income and the cash, the accrual basis net income to be specific.
You know,
so I've got this prepayment here for the insurance. I've got the amortization. I get it, and remember, it doesn't start until month 5 because I'm not going to carry insurance for a concern that doesn't exist yet. During the build-out, I'm not going to have the liability insurance for the actual place. There's other kinds of insurances that are built into the construction costs, right, that you have to have while you're doing a build-out. But that's a different story.
You know, in my opinion, for a small business, the statement of cash flows is probably the most important thing to get a handle on, because you can stay in business as long as you want, as long as you have cash, but, and especially if you're not cash flowing in operations, you really don't have a business. And I think if small businesses would really focus on the statement of cash flows, they'd have a much better chance of surviving. They could take corrective action, you know.
Right, I agree with you 100%, and it's at the same time it's interesting because while I do agree with that and believe that it's true, which is why part of my mission in life has been to set out and show a lot of people that very concept and why it's important. So few actually do. I mean, I even struggle sometimes getting clients to care about the balance sheet.
Oh, yeah.
A lot of clients, because the P&L is the only thing a lot of people understand. If you don't have an accounting background,
and they look at their business and run it by their checkbook. If they have money in the checking account, all is good. If they don't, then it's time to go do more business. Whether they're making money doing that business is a different story.
And they need the P&L for a tax return, so that's why they're concerned about the P&L.
Well, they're concerned about the P&L because they understand it says how much money did I make, and a lot of times they think that's all they need to care about. Until I put out a video that says, here's how you can be profitable and still go out of business because the cash flow is not there. Right? Because I can have a lot of accrual basis income, but if the money's not actually flowing in, I'm dead in the water.
Right.
And as we've often discussed here, you know, the first point at which, going to Gina's point, the first point at which they start to care is two things happen. And you take a typical scenario of a brand new business and somebody who's off and running with a great concept and they're making a lot of money in the first year. And at the end of the year, and like Gina said, all they care about is, do I have money in the bank and does it look about right? Then great, I'm good. I don't care about anything else. And then at the end of the year, they get their tax bill. And not only do they get their tax bill, but they look at the cash in the bank and they say, well, the cash in the bank looks right. I know I made a lot of money, but why don't I have the money in the bank to pay all the taxes I now owe?
Where did it go?
Right.
But I've got a client right now that's is growing way too fast, and what's ended up happening is that he's basically spending his tax, the money goes to the government on inventory, you know, and it's going to catch up with him. I mean, he's like, I've tried to explain to him, you know, I call it the grow till you blow, where you grow way too fast and you outstrip your resources and you just come up short on cash because you got so much, you know, you've stretched your operating cycle so far that, you know, you don't have the working capital to, you know, survive.
Right. Yeah, and so you know what? Since we're talking about it, let me go to the statement of cash flows here. So we're going to go to the statement of cash flows. I want the monthly one. And because this kind of illustrates what we're talking about. So each month I start with my net income. Remember I said because we have such a high amount of rent and in the first few months, you know, we're not going to be taking in any income, we're going to show a big loss, and that's going to accumulate the first few months. Right? And then even in the first few months, once we are operational, it's going to take a few months to fill up all the studios. So we're not going to be profitable until month 7 of year 1. And even then, look how little it is. right? So we need to make sure we have enough cash in the bank to finance that. So we're starting off with $300,000 up front. And originally, the investment amount, as you saw, that we're looking for is $600,000. And let me just widen my columns here so we can see all the numbers properly. But as kind of a bargaining tool, when we go to the negotiation table with the investor, I said, look, cash flow wise, we can make it work based on getting $300,000 up front and getting the other $300,000 later on. And so that becomes a bargaining tool because we can go to an investor and say, look, we want $600,000 and we'd like that commitment from you, but we can survive on just $300,000 initially. And so that, again, all these things matter. They all become a negotiation tool. And look what I've got going on here in terms of the construction. So as I said, we're going to have the construction cost of $300,000, but since we know that we have a unique relationship in which we can pay it back later, then I've got the offset to a construction payable of $300,000. So cash flow wise, the construction is a wash at the end of month 4, and I just accrued it in month 4. I mean, obviously, I can do this all different kinds of ways. I can break it up, into even portions over the 4 months. But in this case, I just said, you know what? Let's just say since we don't have to pay it, let's just accrue the whole thing in month 4 when the build-out is expected to complete. And then what you'll see here is further out, I've got a section where we're actually going to repay it. Now, how did I come up with this? Was simply by looking at the cash flow and seeing when would the money be available to repay this construction loan. And then I have the construction cost payable schedule on the balance sheet. And so here's what that looks like. So here's the accrual, right, where I said, okay, we're going to accrue the $300,000, so that goes here into the payable. We're going to increase the payable. And the next line is the payouts. And so first I looked at my statement of cash flows monthly to see when would the cash flow be there to cover the repayment of this where we're not strapping ourselves too much. And I said, okay, at the end of year 1, it looks like there's enough cash. So let me put 50 grand a month in here as a repayment plan until the whole 300,000 is repaid. And again, I can do, and in this case, I can do this with a lot of flexibility because I understand there's a relationship here. In other cases, it might be a situation where I have to play with scenarios on something like this to see how can I negotiate this with a person and say, look, here's when we can do this, but look, I have conservative numbers here. If anything, the expectation should be that we're going to do much better than what this scenario shows us, so it should be no problem to repay you if you're willing to work with me and wait until the 2nd year. So this kind of detail gives rise to the ability for my client now to look at any possible scenario along the lines of what these numbers all look like, and based on that, plan the cash flow and and decide what can I do. And looking back now, if I go over back to the let's go back to the statement of cash flows. So again, at the end of the day, this is what I care about. Bottom line is line 24 here, the ending cash balance, right? So sometimes what I'll do to do the analysis on this is write a simple formula equals min, as in minimum, open parentheses, and I'll highlight the whole range. What's the lowest my balance ever goes? Looks like the lowest we ever get to is 122,000. And then from there, I can start doing some analysis. Well, what's a good, what we call prudent reserve, right? What's the lowest I would ever want my bank balance to be? Enough to cover how many months of working capital needs? Payroll, for example. And while we're at it, let's look at the payroll model. So again, I have my P&L accounts, and here's my salaries and wages. Now, I've kept this pretty simple. Here I have my monthly salaries. Basically, we're looking to hire a receptionist and pay them $2,000 a month. Right, as a salary. I accumulate the Social Security and Medicare tax, and we have an assumption of $250 per month per employee. And then as a second location opens, we'll have a second receptionist, and so on. And so it just picks up the applicable taxes. I don't bother with the smaller taxes in the build-out for things like unemployment insurance and whatnot because it's de minimis. It's such a small amount. Unless I start having like 100 employees where it is going to add up to a substantial amount, then I'll go and build something like that in here. But when we're dealing with just one employee, I'm not too worried about that. The other reason I might go back and build it in, even with it being fairly simple like this, is if we're running so tight on cash flow that I want to make sure that I am really accounting for absolutely everything.
Hey, Seth?
So, yes, sir.
question. I know with my banking background, a lot of times when you get a loan, there will be loan covenants like maintaining certain, financial ratios like debt coverage or current ratio. Does that impact your projections of your cash flow if you're going to be doing debt financing from old banks?
Absolutely. Absolutely. In fact, I mean, this is what we're looking at here is, 100% equity financing. But when there is debt financing, that's a great point, Dennis, that there are often covenants where you need to maintain usually it's just a quick ratio. It has to be at least a multiple of 2. That's very common. So then what I'll do is on the balance sheet, I will actually build that in. So let's go look at the monthly balance sheet. And I'll build that in, or I'll put a schedule somewhere that looks at what is the quick ratio month over month. The banks are only going to be asking for it on likely a quarterly basis.
Right.
So I'll build that in and I'll put that on the balance sheet to make sure that that ratio is maintained. And of course I'll put a note in the assumptions tab that explains that we need to maintain a quick ratio of at least 2.0. Then we have to look at the last piece of the equation, which is really, this is kind of the holy grail of all this, which is, again, what brought up all this buzz in the first place, which is Shark Tank, and what is my ROI going to be, right? So what happens is, in year 1, this just, everything's pulled by formula down here. We look at what's the investment that they're making. And by the way, breaking up the investment contributions over a 2-year period makes this look better. So again, you're balancing the numbers with how am I going to sell this deal to an investor. So by showing only an investment contribution of $300,000, it makes the ROI look better until such time later on when we can actually start showing, or at least get closer to the point of showing profits. So what happens is, my ROI, of course, is negative right out of the gate. And as we know, we're not going to be profitable for a while. The cumulative net earnings are going to take, it's not until month 15 that we start seeing a positive ROI. So this is one of the critical points on my timeline because I'm going to go to my investor and say it's going to go a little beyond 1 year before you start seeing any return on your investment. Now it's interesting because I asked somebody before I did the Shark Tank course that I did on School of Bookkeeping's website, I asked a good buddy of mine who is very experienced with investing in different businesses, and he owns several of his own, and I said, what's a normal time frame in which an investor can expect to see a return on their investment? And I said, is it safe to say that they would want to see a return within 1 year? And he said, no, that would be very fast for most situations. And of course he qualified that, explaining that you have to know the industry that you're in and what's typical for that industry. But he said in a very general spectrum, 1 year to see an ROI that's positive would be very quick for most situations. So you have to know these things going into this, so that when you go to the negotiating table, when you walk into the Shark Tank, if an investor looks at you and says, well, I need to get all my money back within a year, you're basically, you have the knowledge and the understanding of the numbers to be able to say, that's not realistic. Then don't waste my time in a conversation like this. That you want to be able to be prepared to be able to make those kinds of statements. So the first critical point in the timeline to me is, when are we going to go positive? And then the second one is, when do we return 100% of their capital that they invested? And it's going to drop slightly because, as we open up the second and third locations, we're going to hit loss positions again while we're paying rent and building out the facility. So that's going to impact things, which means the ROI is going to drop for a bit and then it's going to come back up. So based on this scenario, they get all of their money back. They cross over that threshold in month 50.
Hey, Seth?
Yes, sir.
If I'm an investor, I think I'd want some other schedules. For example, I'd want an updated with real numbers and projecting out, and then getting a projection, a current projection that I could compare to see how we're doing, the actual result versus what we projected the month before. Has that been your experience?
Well, yeah, no, absolutely. I mean, what I'm showing you here is what happens before we even get to the negotiating table. Mm-hmm. Assuming the deal goes through and we get the investment, then absolutely, any investor, they'd be out of their minds not to require something like that. I would want to see, at least quarterly, if not monthly, updates with variance reports that show here's what we projected, here's the actual. And as a service, what I have done with clients very often, and what I'm trying to teach bookkeepers and CPAs to do more of on the consulting side of things, is to work with your clients on something like this for their existing businesses, even if they don't have an investor, because it's just a smart way to run your business, to look at something like this, at least quarterly, and say, how do we do compared with our projections? And do we need to revise the projections based on what we're seeing when we make that comparison? Because that's the whole point of it, is to be able to say, okay, you know what, we were way under on the revenues. Looking at a model like this, let's say we don't fill those studios nearly as quickly as we anticipated. Then we want to make the adjustments in the projections so that going forward we hopefully get more and more accurate and realistic about our expectations and the projections that we lay out. I'm going to turn off my screen share there. So that's the whole point of doing this. I'm glad you brought that up, is that once we get the investment and once the business gets up and running, then we can actually do the whole analysis and do it, like I said, each month, if not each quarter, if not each month. And the reality is, the more sort of worried you might be about being on track, the more frequently you want to do it. So my suggestion would be, at the beginning, do it every month. What will happen is, over time, and you'll have sort of an internal barometer on this in terms of where's my comfort level. At a certain point, after doing it for my own business every month, I backed off and said, okay, I'm pretty good. I have a clear picture of what's going on. And in my own experience, what I eventually realized was, the expenses in my business were pretty predictable. So I was rarely ever off on that. It was more the revenues, and it was more an issue of being too optimistic, frankly, has been my problem in the past about how much revenues I'm going to bring in. So I've often had to adjust my revenues downward, but I never would have known that and known to do that if I hadn't done this work, right? And so eventually, because I did this work, I got clear on the fact that this is what I need to do to make sure I'm, if you think of my business as maybe Titanic is a bad word to use, but I want to make sure that I'm steering that on course and staying away from those icebergs, right? So it's just after 9. And I know that was kind of like a lot to look at in one sitting, but I wanted to show you guys. I've done a lot of demonstrations that look at how you're building it, and it's too much inside of a single hour to get the whole thing completed. So I wanted to show you guys what it looks like when it's finished and how you can actually start to use this sort of thing. So any parting questions or words or comments?
You've got a model similar to this for selling on your website?
I don't, because again, everyone changes depending on, because every business has a different chart of accounts and so I could create some very generic templates, but to be honest, what I would say is, and here's where I'm going to throw in a shameless plug since you opened the door for me to do so, is if you sign up for a master's plan at School of Bookkeeping, I can work one-on-one with you and walk you through how to set this up for a very specific client of yours, let's say. And here's a trick. This is a sales tip. If you're worried that your client's not going to see the benefit, here's what you do. Without even discussing it with them, take what's in their QuickBooks file and build the model based on that and get it done, and then call them up and say, hey, I'd like to schedule a time with you where I can go over something. I want to show you something. I think you're really going to like it. Don't tell them what it is. And then get them on the call, share your screen with them, and walk them through it. And I guarantee you they're going to get so excited about what they're seeing that it's almost inevitable they're going to say, okay, what's it going to cost me to have you work with me on this and do it and maintain it every month? I guarantee you it's a way to take existing clients, provide them with something that's going to be really useful and powerful in terms of a navigation tool for their business, and make you some extra money in the process. So everybody wins on every possible level.
Good hangout.
Yeah, I love the ending note. Everybody wins on every possible level. Just doesn't get better than that.
Yep. So anyway, as always, if you guys have questions, post them on the Hangout page or email me. And remember, this is how we do it. Crank it up, DJ EDG.
This is how we do it. It's Friday night, and I feel alright. The party's here on the west side, so I reach for my 40 and I turn it up. Designated by the keys to my truck.
See ya.
Have a great week.